We're living in a high interest rate environment right now, and everyone talks about how it affects real estate. But how does it actually affect real estate? In this video, I'm going to show you exactly what happens when interest rates goes up, what happens to real estate, what happens to payments, what happens to values, what happens to demand. So you have a really good understanding, and next time you're at a barbecue or a cocktail party, you can talk about it and make sure you sound really educated about all these kind of pretty complex matters of interest rates, finance, and prices. Okay, so in short, interest rates affect three different areas of real estate. Number one, mortgage affordability. Number two, investor demand. And number three, it massively affects your ability to refinance and take money out of your house. And together, when interest rates spike, it can really have a devastating impact on your ability to afford a house and on the real estate market overall. So in this video, I'm going to lay out exactly what happens when that happens. Let's dive into it. So let's talk about mortgage affordability first. Most people in the United States don't buy houses cash, right? Most people just don't have that kind of money. And it's obviously, as a matter of fact, the average down payment of a house is only 14.71%. That means that the average American finances 85.29% of their home purchase price. In other words, you buy a house for $100,000, you pay down $14,710 as a down payment on average, and you finance $85,290. And obviously, those numbers go up. It's $1 million home, it's 10x of that. Hope that makes sense. Now, with that said, on that mortgage balance, there's a payment that you have to make. Like, it's logical. The bank doesn't give you the money for free. That payment typically consists out of two pieces. Number one is interest, and number two is principal. Interest is obviously what the bank charges in exchange for you being able to use their money. You don't just give your bicycle to somebody for free. You charge a fee for somebody to use your bicycle. The loan is the bicycle of the bank. They give you the money, and in exchange, you promise to give the money back, plus some interest. Now, those interest rates, back all the way until early 2022, were in the below 3 or let's say around 3 to 4% range. So you basically borrowed $100,000, you paid $3,000 a year in interest. Well, guess what? These interest rates have gone up to 7.5%, 8% now in 2023 and beyond, and we all hope that they come back down. But obviously, as you can see, if instead of paying $3,000 for a loan, you now pay $7,500 for a loan, it makes borrowing money much more expensive. The second kind of category that you have to pay is the principal. Because again, the bank just doesn't give you an interest-only loan. Those exist too. But typically the goal is to get a 30-year fixed rate mortgage where you actually over 30 years pay off that loan all the way. So what happens is every month that you pay this back, you pay a portion of interest and a portion of principal. So let's calculate on a real life example what happens when interest rates are low and what happens when interest rates are high. And for that, I'm going to use my flip chart. So let's say we're using an average American house that costs $460,000. You're putting down $60,000 and you're taking a mortgage of $400,000. So let's say $400,000 is the mortgage, and the interest rate is 3%. So this is pre-inflation, pre-2022, before the Fed raised the rates up the wazoo, and we're now paying way more. So before that, this is the amount that you borrowed. This is the interest rate. With that, the monthly payment is, and that is both principal and interest, is $1,686 per month. All right. So this is what you had to pay to afford that kind of a property. Well, for many people, that's affordable. If you make, I don't know, $60,000 a year, if you and your spouse work together and each of you have a $50,000 a year job, you're making $100,000, that is a very affordable payment. Now, let's fast forward to 2023. Today, let's say interest rates are at 8%. Today, that loan no longer costs you $1,686. Instead, that loan now costs you $2,935. So in today's world, the loan here costs you $2,935 a month. This is a difference of over $1,249 a month. So in other words, what does that mean? When interest rates went from 3% to 8%, that same house that cost $460,000, you put $60,000 down, you had a $400,000 mortgage, now costs you per month over $1,249 more, meaning almost $3,000 goes to the bank. And at that point, it becomes really, really hard to qualify, because not everyone makes enough money to qualify for a $3,000 loan. Lots of people qualify for a $1,600 or $1,700 loan. Much less people qualify for that. So now what does that do to the real estate market? Well, if less people qualify for the loan because it costs so much more to pay it off, that means there's less buyers that actually can make an offer on that kind of a house. Well, if there's less buyers equals less demand. Less demand equals less offers. And with less offers means that a lot more houses are going to sit on the market with no offers. And that means that the sellers eventually are going to drop the price. Higher interest rates means eventually, in a normal market, means that the real estate prices are going to come down because there's simply less people that can afford it. Therefore, there's less people on the market buying the properties. And if you have less demand but the same supply, guess what? Prices are going down. Another factor to consider is the effect of not being able to actually refinance. Because here's the thing, when interest rates were low, lots of people flocked into the market. Everyone could afford these houses. Lots of buyers went after these houses, so prices kept going up. And when prices keep going up, the people that bought this house at $400,000, well, guess what? A year later, it might be worth $500,000, because even at $500,000, this payment is only, well, about $2,000, still very affordable. So what happens is, once you have equity in your house, you can actually go and refinance that equity out. Again, since interest rates are low, you can refinance at the same or even a lower interest rate, pull money out of that property, and now what do you do with that money? You buy a new car, you go on vacation, or if you're smart, you actually go put that money and buy another house that you now use as a rental. So there's an effect of refinancing. It's a wealth effect to the United States. It's a wealth effect to the economy, that people pull money out of their houses and now they actually consume more, and it keeps fueling the economy. So let's fast forward into 2023 when interest rates are at 8% and you can't do this anymore. So you buy a house right now, $460,000 house, $400,000 mortgage, 8% rate. Let's say you qualify for that. But guess what? The market stays at that 8%. Prices are not going to go up anymore. Prices actually might come down a little bit, and your equity gets eroded a little bit, and there's no chance for you to go and refinance. And also, why would you refinance? Because you would refinance into a really high interest rate. Also, nobody of these guys, if you bought your house 2 years ago and you got a 3% interest rate, you wouldn't go and refinance right now anymore, because you can get money out because the values are still high, but you would refinance into an 8% interest rates, which would increase your monthly payment drastically. You don't want to do that. So as a result, currently, nobody is refinancing. The refinancing marketing has been crushed. There's almost nobody that does that. As a result, guess what happens? Mortgage companies are in trouble, but also the wealth effect to the United States economy has gone away. People are not pulling money out of their houses anymore. As a result, they're not putting it into new cars and vacations and things like that. They feel poorer, and as a result, the economy overall is not as much humming as it was before. So again, interest rates have a lot of impact on the health of the United States economy. Low interest rates means that people can pull out money, means the demand for houses are there, prices go up, people can refinance, people can use that money, everyone is happy, everyone feels wealthy. High interest rate means less people can afford houses, prices stagnate, so prices might even come down, nobody refinances, nobody even sells their houses. Actually, these people wouldn't even want to sell their houses. So while prices stay stable, because there's not a lot of inventory in there, because nobody wants to sell a house and get less for it than they got before. Also, nobody wants to sell a house, because when they have to buy a new house, they now have to get a house at an 8% interest rate. Nobody wants to do that. So everyone holds on to their houses. As a result, there's just less movement in the entire economy. So high interest rates is actually not good at all. High interest rates affects everything pretty much across the board. I hope you now have a much better understanding of what interest rates do to the economy overall and to real estate in specific. If you enjoyed that, make sure you subscribe to this channel and share it with your friends.